Hi, my name is Lisa Cummings, and today I'm going to share with you some information regarding the suitability of a cash balance plan for a particular business. First, I'd like to share with you a little bit of information about our law firm. Our law firm is Cummings and Cummings Law. You can find our website at www.cummings.law. We are a full service law practice. We serve business owners, we serve executives, real estate developers, individuals needing to move their business, grow their business, uh, ensure that there are tax opportunities that are explored and achieved within the exact confines of the applicable rules and regulations for the state involved, as well as the federal level. And then also, I wanted to share a little bit of information about myself. I have worked throughout my career with large companies, assisting them with designing compliant retirement plans, health and welfare programs, compensation programs, and executive compensation programs. Today, I'm going to share a little bit of information with you about a cash balance plan and when it makes sense to add a cash balance plan along with a 401k plan. If you already offer a 401k plan and you're thinking, we are maximizing the value of this plan, but still leaving some tax savings on the table, you are asking the right question. The next step for many profitable professional practices and closely held businesses is not replacing the 401k plan. Instead, it is layering an additional plan or retirement plan on top of it, commonly a cash balance plan, to create a significantly higher deductible contribution amount. In this video, I will walk through eligibility and suitability. Who can do this? What companies can do this? What companies should not do this? And what a proper feasibility analysis should look like before you commit to a cash balance plan. So what does a cash balance eligibility really mean? Well, let's separate two ideas, eligibility and suitability. Eligibility is a technical question. Can your company sponsor an additional qualified retirement plan alongside an existing 401k plan? In most cases, yes. Many employers sponsor a 401k plus a cash balance plan or a 401k plus a profit sharing component that is contributed into the 401k account of each participant. However, suitability is the true business question, and this is where the strategy comes into play. Will the economics work for the company, and will the ongoing funding obligation be sustainable? Cash balance plans can be very powerful, but they are not casual. They work best when the business has stable cash flow and the owner is ready to commit to a multi-year funding strategy. Why certain businesses will add a cash balance plan on top of a 401k plan relates to the following. If you already have a 401k plan, you're probably doing one or more of these things. You're allowing the employee to contribute or tax defer part of their compensation. You may also have an employer matching contribution, and you may also permit an additional employer profit sharing contribution to the participant's account. However, you may still want more. The common reasons owners explore a cash balance plan are higher tax deductions, accelerated retirement savings, and a more strategic allocation of contributions based upon age and compensation. The key point is that cash balance contributions are generally employer funded and can be designed to create much larger contributions for certain groups, especially older owners, while still meeting federal non-discrimination rules. The green flags or reasons why your company should be a strong candidate for a cash balance plan include the following. If your company has consistent profitability and cash flow, and the revenue and profits are stable year over year, that means that your company will be able to support the plan's ongoing annual funding expectations. If the owner compensation is high and predictable, and the owners have a strong W-2 income or consistent pass-through earnings that support large contributions, the planning gets easier. If the owner is in the catch-up years, that is, They would like to be deferring more of their income to retirement. A cash balance design often becomes a compelling reason as the owner gets older because the math of the funding of a targeted pension benefit allows larger annual contributions as the employee grows closer to retirement age. Another reason that a cash balance plan may work is if you have already optimized the deferrals to the 401k plan. In many cases, the right sequencing is to first maximize 401k plan design, which would include additional profit sharing if appropriate, and then add a cash balance plan to go beyond what the 401k framework can efficiently do. And then finally, and very importantly, the workforce demographics would support the cost. The feasibility almost always comes down to the age and the pay of all of your company employees. If the owner group is older and substantially more highly compensated than the staff, and the staff group is younger and lower to moderate paid compared to the owners, the plan can often be structured efficiently, subject, of course, to federal compliance constraints. The red flags are reasons why your organization may not be a good cash balance plan fit would be unpredictable profits or volatile cash flow. If your company has big swings committing to pension style contributions that have to occur under federal law every year, could create stress. If you want a 1 year only contribution, a cash balance plan is not intended to be that solution. A cash balance plan is intended to be maintained for a period of years. It is not designed to be turned on and off like a bonus plan. If your workforce is older and highly paid relative to the owners, then most likely the cost to provide the employer contributions for these more highly paid staff will become cost prohibitive and would not be a good fit for you. If you have compliance issues with the existing 401k plan, now is not the time to add a cash balance plan, such as if the 401k plan has operational problems, late deposits, inconsistent eligibility administration, missing amendments, failed testing. First of all, the IRS will be very interested in your getting those resolved very quickly. Putting additional complexity of a cash balance plan on top of a shaking foundation is asking for trouble. Might I add, if you do have such IRS concerns with your existing 401k plan, our firm is strategically available to help you resolve those particular 401k concerns and get those in place, get that plan working smoothly, and then you could consider a cash balance plan. If you do not appreciate complexity or you cannot tolerate any sort of administrative complexity, a cash balance plan may not be a good fit. A cash balance plan requires actuarial work. That means actuaries will have to review the funding of this particular plan every single year. They will have to, under IRS requirements, make an annual funding analysis and also carefully coordinate with your 401k plan. If the business culture at your organization is set it and forget it, a cash balance plan may not be a good fit. I would offer that if you would like to have a 401k plan in addition to a cash balance plan, our firm is uniquely capable of administering those things for you, of course, with the assistance of receiving the required information and ensuring that your organization can provide the fundings on an annual basis. So what types of companies typically benefit from a cash balance plan? Medical and dental practices, law firms and consulting firms, engineering and architectural firms, and closely held businesses with strong profits, especially when the owners are in their 40s, 50s, or 60s and wants to catch up on setting aside money for their retirement as retirement age is quickly approaching. A 401k plan provides an account upon which you can build. A cash balance plan is a pension formula dressed up in account clothing, designed to allow higher tax advantage contributions when and if it fits your business. Some practical next steps. If you already have a 401k plan, first confirm your existing 401k plan is optimized and compliant. Then run a cash balance feasibility study using current census data. Next, review the multi-year contribution commitment and employee cost impact. Determine if that cost is something to which your organization can commit for several years. And then decide whether the tax savings for your organization and the retirement funding benefits justify the administrative complexity and funding responsibility. When the fit is right, a cash balance plan can turn a standard 401k plan into a high-powered tax and retirement strategy. When the fit is wrong, it can become an expensive obligation. The goal is to know which one you are in before you sign anything. If I may provide you with any additional information, send me an email. My email address is lisa@cummings.law. Thank you for joining today.